You spot a perfect support level and place a buy order right on the line. Then the market dips just low enough to hit your stop loss before rocketing in the direction you predicted. This happens because of a failure in geometry. Traders often treat dynamic market levels as if they are rigid, mathematical lines. Real support and resistance are actually footprints of human emotion. They mark the areas where buyers find value, sidelined traders feel the regret of missing the first move, and short sellers begin to panic as their profits evaporate. Professionals delete those thin lines and draw 10 to 20 pip thick zones on their daily and 4-hour charts. These zones encompass both the candle bodies and the emotional extremes shown by the wicks. These zones are battlegrounds where institutional players fulfill massive orders. They often use the predictable stop losses of retail traders to create the liquidity or the necessary volume they need to enter their own large positions. To stop being the source of that liquidity, you have to move past single-line predictions and adopt a strict, rule-based playbook designed for the chaos of these zones. High-probability daily zones show multiple touch-ins and drastic rejections. Since markets range 70% of the time, trade the boundaries. Wait for the price to pierce the edge, then close inside. Target the opposite side, placing your stop loss outside. These ranging markets offer highly defined profit boundaries for traders patient enough to wait for the market to reject those extreme edges. A fakeout occurs when the market spikes aggressively above resistance, triggering amateur buy stops and liquidating short sellers. This creates a sudden volume burst for smart money. The rule for this trap is simple. If the 4-hour candle spikes out but closes back inside the range, counter it. Enter your trade inside the established range, with a strict stop loss just above the fakeout spike. Professional traders recognize these sudden spikes as liquidity grabs and use the failed momentum to trade in the direction of the dominant institutional flow. If the price breaches a zone with sustained momentum and closes outside, the range is broken. The common mistake is buying into the initial surge out of FOMO. This usually guarantees you are buying at the most expensive possible price. The professional rule is to wait. Let the price drift down to the recently broken zone, allowing old resistance to become a support floor. Before entering, wait for a clear confirmation candle to form within this newly flipped zone. Success in a breakout isn't about predicting the surge. It's about having the patience to let the market verify its new foundation. A trader can execute these setups perfectly and still destroy their account if they lack mathematical risk controls. Swing trades often last several days. To survive the natural daily fluctuations of the market, these positions require wider stop losses than typical day trades. To manage this, professionals use the 1% rule, meaning they never risk more than 1% of their total capital on any single trade. On a $10,000 account, 1% risk is $100. With a 100 pip stop loss, you reduce position size to 0.10 lots. Trading a standard lot instead costs $1,000, wiping out 10% of your account. Move from theory to practice by cleaning up your charts. Draw your major daily zones and test this conditional playbook in a demo environment to see how the rules perform live. Identifying these zones helps you recognize high-probability moments to engage the market, but mathematical discipline is the shield.